if you make $200,000 a year in California, the state takes almost 28,000 of it before you ever see a dollar. In Texas, zero. But here's what nobody's telling you on no income tax. We tell you that mark can flip completely upside down depending on what your house you buy. Okay, I've seen people move here thinking they are saving 20,000 grand a year and then got blindsided by a property tax bill that eats half of it. So today I'm going to show you the actual map, not the Instagram infographic version, okay, the real version, so you know exactly what you are walking into before you make one of the biggest financial decisions of your life. And I'm going to break it down into different sections so that you understand the clear picture. The number one thing you need to understand is the income tax gap. California runs a progressive income tax system that tops out of 13.3% of the highest in the country. Texas has no state income tax at all. It is written into the state constitution. Here is what actually looks like at different income levels. Income in California, state income is approximately 100,000. You're going to be paying 5,800 to 8,200 a year. In Texas, zero. If you're making anywhere from 150,000 to say 200,000, you're paying anywhere from 11,000 to 14,200 a year. In Texas, zero. That is real money. On a $200,000 household income, you are talking about $14,000 a year before we have even touched property tax, before we have touched sales tax. That is a car payment. That is a semester for private school. That is a chunk of your kids' college fund every single year just for the privilege of earning money in California, okay? And let me be very clear here so that you understand everything. And that gap gets worse the more you make. At $500,000 in income, the difference between the two states can climb past $50,000 a year. That is not a rounding error. That is a second income. Number two thing is a trap nobody talks about. Here is where most of this move to Texas, or why people move to Texas and save a fortune videos stop. And that is exactly why they are misleading or being blindsided by the whole thing, because Texas make up for having no income tax with one of the highest property tax rates in the country, averaging somewhere between 1.6% and 1.9% of your home value every single year, and also depending on the location. California, by comparison, sits around 0.7%, and thanks to Proposition 13, passed back in 1978, your property is only reassessed based on your purchase price, capped at 2% growth per year, not current market value. So here is a scenario that catches people off guard. Say you bought your California home in 2012 for $450,000. It's worth over $1 million today. But because of Proposition 13, you are still only paying property tax on assessed value of maybe $540,000. Your bill somewhere around $5,000 a year. So you sell the house, move to Houston, and buy a $500,000 home. Literally half the value of your old house. Feels like a win, right? Your new property tax bill, roughly $10,650 a year. That is a trap. You didn't just move state. You move from a system that rewards you from staying put into a system that taxes you on what your home is worth right now. Every year, no cap on the reassessment. The number three thing I want you to take note is, so where is the actual break-even point? That is the question I want you to ask. This is the part that actually matters and is the part nobody gives you a straight answer on. Based on current rates, the crossover point where Texas clearly wins is around $120,000 to $140,000 in household income. Below that, if you are a long-term California homeowner protected by Proposition 13, the math can generally be closer than you did expect. Sometimes California even comes out ahead above that income level, especially if you're buying a moderately priced home instead of stretching for the most expensive house on the block. Texas wins and is not close. Let me give you a real example using Houston numbers specifically, since that is what I actually work with every day. Okay, family earning $200,000 every year, buying a $500,000 home in a place like Katy or Sugarland California, 14,200 income tax plus 3,500 property tax equals 17,700 a year. Texas, zero income tax plus 9,000 property tax equals 9,000 a year. That is a saving of roughly 8,700 a year, almost 9,000 every single year you own that income. Now stretch that same family into a 900,000 home instead, and suddenly that Texas property tax bill jumps to 16,200, and the advantage nearly disappears. This is the single most important thing I tell every client relocating from California. The house you pay determines whether this move saves you money or barely breaks even. It's not automatic, it's a decision. Number 4 thing I want you to take note here is a piece everyone forget, and it's called SALT. SALT. Quick but important one. The federal SALT deduction, state and local tax deduction, got a major update recently. It is now capped at 40,000 for 2026 and up from the old 10,000 cap. Why does this matter for you? Because if you are a high earner in California paying tens of thousands in state income tax, you cannot deduct a lot of that on your federal return that you could a few years ago, which slightly narrows the gap. It doesn't erase it, but it's a piece of the puzzle your CPA needs to be looking at, especially if the first year you make the move. When residency timing gets complicated, I'm not a CPA, and this isn't tax advice, but if you are seriously considering this move, this is exactly the kind of detail that should be part of your conversation with one, not something you find out about after you have already sold your home. Okay. Number 5 thing I want you to understand here is the bottom line. Here is what I want you to walk away with in this video. Texas has no income tax. It's true, and it's also not the full story. The rematch depends on 3 things. 1, your income. The higher it is, the more Texas wins. The more you buy, the more modest the home relatives to your income, the more Texas wins. How long you plan to stay or plan to live in this area. Prop 13 rewards California homeowners for staying put. Texas doesn't punish you for moving, but it does not discount for your loyalty either. For most of the families I work with, dual income household moving from California in the $150,000 to the $300,000 range, buying in the $400,000 to $700,000 range in places like Katy, Full Share, or Sugar Land, the savings are real, they are significant, and they show up in year 1. Okay, but I did rather tell you this. You know the actual numbers before you move that find out after your first Texas property tax bill shows up in your mailbox. California is taking a larger percentage of your income, especially if you earn well, invest, or build businesses. The 13.3% income tax rate is real. The capital gain tax is real. Texas has higher property taxes than most people expect. I'm not going to pretend otherwise, but for the majority of working professionals and investors running this comparison, honestly, Texas wins. The people who are going to look back in 10 years and say, I can't believe how much work I built. Those people are running this number today, right now, not sitting on the sideline waiting for the perfect time. Don't be that person, okay? If you are thinking about buying a home in Texas, relocating from California, or you just want someone to run your personal number for free, drop the word Texas in the comment and I will send you my relocation guide right now. And if this video gave you clarity you didn't have before, subscribe, because every single week I am giving you the real numbers, the real math, and the real strategies that the people building real wealth in Texas are using right now. What you don't know in real estate can cost you a lot of money, and I will see you in the next video.